Today, we're going to talk about my 4 most used option trading strategies. And I've been trading for over 18 years now. This is pretty much what I do. But the conversation that we're going to have today is going to be a little bit of knowing for, I'm assuming, most of you, but for the select few that can follow the thought process behind what I'm sharing, you will actually likely find this to be very useful. At least that's my goal. Otherwise, I wouldn't be sitting here. So let's dive in. The very first thing you'll see is profit mechanism. Why is profit mechanism on this instead of giving you iron condor or a vertical spreads? Something like that. It's because in order to build an option strategy, you have to base it on some sort of profit mechanism. That is the first step. And if that doesn't make sense to you, let me explain it. It does not matter if you use a put vertical spread, a call credit spread, a long straddle, like none of that matters unless you can match it to a market effect that you can measure and make money from. I have a video that talks about this in detail called the outlier strategy process. It's just a framework for thinking. I'll throw a link to that in the notes below. We're not going to repeat that here, but this is the starting point, and I'm going to show you how I find these different profit mechanisms. Then after profit mechanisms, what I like to do, and again, this is based on the outlier strategy process, is outline different structures. How can I potentially trade these things? Finally, turning them into actual strategies. Now, all of the strategies that we're going to go over today have literally their own playlists on the channel. So you can go into those, find tons of examples, deep dives into the strategy themselves. We're going to go through some of that today as well. All right, so let's talk about these profit mechanisms. The very first one, positive drift. Lots of different ways to think about positive drift, but I am a simple man and I'll show you how I think about it. If I take us over to the platform and we take a look at SPX, this is going back from its inception. So if I go all the way back into the late 1920s, and I just scroll through time, what do I notice? Well, I notice that this thing goes up. Now, there's different time frames that you can consider a effect like positive drift. I'm talking about the very long-term effect. There are shorter-term effects, things like that. The profit mechanisms that we're going to talk about today, there's 3 of them. These are only one profit mechanism. There's way more. Another example for positive drift is something like post-earnings announcement drift and so on. So the example I'm using in this context is that very long-term chart I just showed you. This essentially is based on an expanding economy, the fact that companies continue to grow because they find ways to innovate, become more efficient, and make more money. Notice how I'm taking the time to actually define the profit mechanism. It's because there's no strategy that you can think of trading without understanding the actual profit mechanism that you are trying to trade. Because of the one that I just showed you, we can immediately think about different kinds of structures that might fit that, which we'll talk about. Next one, volatility risk premium. This is another one that we can actually observe pretty cleanly. So if I pull up this vol plot, you'll notice that there's these 2 yellow lines, 2 white lines, then there's this purple line. Really, the purple line is measuring the difference between 30-day implied vol and 20-day realized vol. So if I zoom this out pretty far, what do I notice? I notice that this line is typically purple. So this means that in general, implied volatility is trending over realized volatility. This is a standard trend. And again, I can explain this. It's because things like the S&P 500 index, SPX, is commonly used to hedge the downside. People are willing to overpay for that downside protection, and we can measure it. We can find when it's most prevalent, least prevalent. This process of analyzing the profit mechanism, as you see, is going to be highly informative when we get to the strategies. Another thing that I like to do, as most of you know, is I like to actually look at research because it's available. It's free. It's there for everybody. You can go to SSRN, Social Science Research Network, and type this stuff in and see what's out there. So we can see that there's a relatively recent paper from 21 empirical study on risk premiums in the S&P 500. We have another paper here that talks about ETF trading strategies. Not saying all of these are going to be gold. This one I actually would take with a grain of salt. I typically look for peer-reviewed research. So you can see this is an independent writer. So I normally like to find things that are peer-reviewed. But nonetheless, even stuff like this can give you some ideas on the effect that you are trying to trade. Okay, so volatility risk premium, that's another one. Last one, momentum, another super heavily cited market effect. We can research it. There's all different kinds of momentum effects prevalent in the stock market. This is where we come across approaches like sector rotation strategies, where we buy the top 3 or 4 sectors. We short the bottom 3 or 4 sectors based on a prior performance and an expectation of a continuation of whatever that direction is. So these are the profit mechanisms I'm going to show you, the strategies that I trade the most. Now, the fun thing about these strategies is the way that I use them is the strategy applies to a ton of different profit mechanisms. What I trade in total is actually pretty simple and not a large list anymore. And it's because you'll find simplicity is truly the ultimate form of sophistication. If you could do the basics really well, you can make a lot of money. So let's take a look at what structures might make sense for these. And before I click through them, list your own. Based on what I just showed you without going into quantifying things, what do you think might fit this stuff? Well, for positive drift, we can buy calls, we can buy stock, we can sell puts. Is this an exhaustive list? No, but these are the basics. These are ways you can capitalize on positive drift. Are all of these going to be created equal? No. They're going to have different risk reward profiles and different overall performance. So based on the specific form of positive drift that you are trying to trade, you have to think through which of these is a good starting point for your development of a strategy. Volatility risk premiums. We just said that typically vol is overpriced. So we can capture that by selling volatility through straddles, strangles, single options, sometimes if you have a directional bias, and then momentum. You can essentially use the same suite of things from positive drift, but you'll notice that momentum is both directions. Positive drift, positive is upside. You can also have negative drift, but momentum as well can be positive or negative. So in this case, this is to trade both directions, up or down. And again, these are not all the profit mechanisms I trade. This is just 3. I trade way more profit mechanisms than this. However, the number of strategies that I use to trade the total profit mechanisms are all essentially going to boil down what we're going to look at now, which are these. This is pretty much it. For positive drift, I'm going to trade things typically like the covered strangle or ratio call diagonals, which is upside based. I'm going to go through what each of these are on the next slide, so don't worry. Volatility risk premium. I'm typically going to use short strangles. Typically, I'll use straddles, but typically short strangles, and sometimes I'll even add the wings. Then for momentum, I'm typically going to trade a ratio diagonal that I eventually might add the short option. I very rarely will add the short option component up front. And again, I'll show you what all of these actually are. So starting with the covered strangle, we have a cash secured put that has 2 destinies. It's either going to be out of the money or in the money. This cash secured put can be really any DTE. For me, far more often than not, less than 60 days to expiration, and something between a 20 and 30 delta if I'm not necessarily trying to get assigned. If I want to get assigned, I'll get more aggressive, go to 40 or even 50 deltas, and then take the days to expiration closer in time. That's a way for me to essentially use short premium as a way to pick up more shares, but that's at an opportunistic pace. If I want shares, I will literally just go buy them outright as well. And for those that have been following the covered strangles that I've been trading in the sample portfolio, the subset of my broader portfolio, you'll notice that I do this quite regularly. Now, the kinds of things that I'm going to trade the covered strangle in are generally going to be some sort of ETF. Not always, but typically. Why is that? It's because, again, the covered strangle is really designed to take advantage of a very long-term profit mechanism. So it's something that I really want to feel comfortable holding long-term, and ETFs normally scratch that itch for me. Now, the second component to this is generally a ratio covered call and then additional cash secured puts. So the ratio covered call is very simple, and we'll literally look at an example now together. If I click over to SSO, which is a 2x levered ETF in the S&P 500, this is one that I literally am running a covered strangle in right now. So if we go to analyze, you'll be able to see a version of my trade. Here you can see I am short 10 of the 88 puts. I sold them for $2.02. That was the origin of this trade. So right now, the trade is making a little bit of money, not a ton. And this is the starting point. Now, for something that's a little bit deeper in the process, TQQQs, we go to analyze, you'll notice that this one looks way different. In this case, I have the short put components, I have the short call components, and then I have the long stock. In TQQQs right now, the short puts is a 10 lot. The short call is a 1 lot, and then it's long 150 shares. Again, this is based on the sample portfolio, which is like a subset of the broader portfolio. And notice the P&L curve, a couple really important traits. Notice how it's positive sloping. It has uncapped profit potential. That is the point of the ratio covered call component. If I take off these additional puts, you'll notice that it still makes upside profit. The reason for this is I'm selling the puts simply to make a little bit, I'm selling the calls to make a little bit of premium for the underlying holding if I'm not expecting it to skyrocket. If I'm expecting it to skyrocket, I won't sell the calls against the shares. But when it's this slower kind of grind, then the calls offer another premium source. And then for the short puts, well, we already glossed over variance risk premiums, and we know that the put side on indices tends to have higher implied vol than it should across the board. And the reason why this put skew exists is, again, people are hedging to the downside. So that juices up the premium on the put side. That's why right now I'm short 10 contracts of those puts and only long 150 shares. So that's the covered strangle. Next, we have ratio diagonals. This is going to be a long option, call, or put that are typically longer days to expiration, generally speaking, at least longer than 60 days, more often than not, greater than 90 days out. Definitely looking to close or roll the position as it starts closing within 50 days if I'm still holding it. So this is the starting point. And then after a while, based on price behavior, I will then sell either calls or puts, depending on if I'm long, calls or puts, it's the same side. So calls get calls, puts get puts, that at a closer days to expiration. So closer expiration. And the point of this is to just, again, take in some short premium while not capping my upside potential. And it helps subsidize the cost of theta decay in these longer term long options. Now, there's a bunch of reasons why I go long term. I typically go at the money, 50 delta, or deep in the money, 70, 80 delta, depending on how much I think the thing is going to move. It really depends on the context. And again, there's playlists that go into all of these in detail. But a current example of this trade is Palantir. So I gained entry in Palantir a while ago, but I'm going to show you two of my more recent legs that I've gotten into. So if we go to analyze, you'll see that there's actually two sets of long options and two sets of short options. And it's because I phase into the trade. So in this case, I have a 5 lot of the 130s, got those for 1980. And then against these 130s, I had sold the 140s in 18 July for 638. Then I have 8 of the 200s, same expiration, 15 Jan 27. Those were picked up for 29.5. And against those, I have 3 of the 155s for 415. So you notice how this still has a ton of upside profit potential. So what I do with these short calls typically is when they get challenged, I either will roll them out and up ideally, or I will unwind some of the long options to cover the cost of the short option. That's typically when I'm at a point where I really want to start taking some of the trade down and phasing out of the position. And again, this is designed to trade something that's exhibiting this strong momentum factor, and that can again be measured pretty carefully over different time frames. The last strategy, straddles, strangles. In this case, I'm really going to talk about short strangles. That's been more used by me over the last 2 years or so. It ebb and flows depending on what it is. So in this case, this is for the variance risk premium play. And I'm giving the example of zero DTEs. There's, again, different versions for this. You could trade earnings releases. That's another great place for variance risk premiums and so on and so forth. So in zero DTEs, I kind of have a complicated approach at this point where I'm doing volatility sampling throughout the day. But the base strategy that I'm trading here is at different points throughout the day, I'll look for an entry and it'll be short a strangle, either at somewhere in the range of a 10 delta to 35 delta, typically around 25 delta. Now, the main thing is in the sample account that I typically cite the trades in, just to keep everything in the same language, I actually very often will add wings to this. So in SPX, if we take a look, we can measure again volatility for different time frames. I wouldn't use this for zero DTEs, and it's because this is 30-day vol. It doesn't really matter. We need shorter term measures for vol if we're trading zero DTEs. So that's a whole other video. But if we take a look at the daily moves here, you can see these larger days typically are going to have a little bit more premium baked into them. Now, I'm going to show you a strangle that might be something that I have on. Now, this is not a perfect descriptor, and it's because this is using a one-day option. Zero DTEs won't have any premium, so it won't show you anything. Now, I want to show you the strangle first. And again, this is using 26 and 27 deltas, so pretty low on the delta front. So you can see undefined risk. So in smaller accounts, defining the risk, it does slow down the overall performance, but it's a necessary evil in order to be able to put the trade on and keep the risk at a controlled level relative to the account size. So if I look across my trading activity, the overwhelming majority of what I do falls into these buckets of strategies. Sometimes for the diagonals, it'll just be the long option and the shorts never go on, but the shorts might go on. For the risk premium style plays, that's typically going to be strangles. And then I almost always have a covered strangle on. This is exactly how I do what I do. Now, one of the big things with being able to create like a consistent performance over time actually really comes down to, especially with the covered strangle, is being able to move into and out of the underlying itself. So I tend to apply a momentum following approach there, especially if I'm trading levered ETFs. So a lot of stuff. If you have any questions, let me know. Be an outlier. See you guys later.